Chainlink just experienced an 8% decline in a single session, and here's the kicker. This happened during the protocol's biggest buyback since August. If you think that doesn't make sense, you're absolutely right. Let's break down what's really happening behind this massive disconnect. Thursday's movement saw Link drop from $18.39 down to $16.92, breaking through the $17 psychological threshold. But it wasn't just the percentage decline that caught attention. Trading volume exploded to 3.94 million units, nearly double the typical levels. That kind of volume surged during a breakdown. That's institutional money shifting positions, not retail panic. The $17 level has now flipped from support to resistance, and multiple recovery attempts have failed. Even more concerning, volume dropped 58% during those bounce attempts. When buyers refuse to show up at oversold levels, the market is sending a clear message. Now here's where things get interesting. While the charts painted a bearish picture, fundamentals told a completely different story. Ondo Finance just selected Chainlink as the data provider for over 100 tokenized real-world assets. This is massive for Oracle adoption. Even better, the Chainlink Reserve acquired 64,445 Link tokens, their largest purchase since the program launched. Their holdings now sit at $11 million worth of Link. The protocol is literally accumulating its own token during weakness. Yet the market hasn't responded, at least not yet. JHKXWL platform data reveals this fundamental technical disconnect across multiple timeframes, showing how institutional flows can override even strong catalysts in current market conditions. So what are the levels to watch? That $17 barrier is now your first resistance. The more formidable ceiling sits at $18.20. On the downside, $16.50 is the next support zone, with $16 becoming increasingly likely if consolidation fails. The volume profile tells us everything. That massive spike confirmed institutional distribution, but the lack of follow-through on bounces shows those same participants aren't interested in reversing positions. This creates an environment where downside risks currently outweigh upside potential. The takeaway? Fundamentals and technicals don't always align in real time. Sometimes markets need to digest negative sentiment before positive catalysts gain traction. For now, the direction points lower until buying volume returns or consolidation stabilizes. Smart money seems content to wait this out rather than fight the trend. Stay sharp, track your levels, and we'll see you in the next one.